Hey guys, welcome to another episode of Ironis Insights. I got another guest here, Tom Costello, CIO of Bedrock Digital Asset Management. Thank you so much for going to share some insights with us today. Thank you,
Yeah,
Tom.
my pleasure.
Where are you calling from?
Well, I'm in New York City. Our main office is in the Chicago suburbs, but I have an office here in the house, and I live in Greenwich Village.
It's beautiful. Yep, I'm in the Upper East right now, and we're on Fifth Avenue. Yeah, so not too far.
Yeah, I'm just off of Fifth Avenue.
Beautiful. Yeah, we're at 89, right by Union Square, kind of. Awesome. Well, thank you so much for joining us. Before we dive into a couple of things we were talking about offline, I want to give a little background. Like how did you get to where you are today? How did you get into digital assets? Why don't you dive into that a little bit?
Sure. Well, I started as a quant at JPMorgan back when we rode our dinosaurs down Wall Street to get to work. Uh, that was the early 90s. I was a quant on the exotic swaps desk, and that was a different job back then than it is today. Um, there's a lot of custom derivatives and custom pricing models and that sort of thing. I stayed on the sell side, the banking side, and institutional finance for um, I don't know, 6 or 7 years. I was there. I was at Deutsche Bank. I was at Chase when JPMorgan and Chase were two different companies. And then I moved over to the buy side, is what we call it in the industry, is a hedge fund side. I took a job as a research analyst at More Capital, still in on the research side, but I wanted to run a trading strategy. So I left Moore and went to a firm called Caxton Associates, where they let me do that. I built a strategy. It turned out to be quite successful, lucrative, and from there I went to Tudor Investments. Then I was head of equity trading for a slightly smaller quant-only fund. I was about $1 billion under management. And then I was sort of semi-retired, so I got a divorce, and now I'm back in the hedge fund business.
Back in the hedge fund business, back to buying. All right. Well, listen, I mean, this is a very impressive resume. I mean, you've been through a whole
Oh,
different
thank you.
a whole different set of just standards. Like you said, what you were doing in the 90s is not the same job anymore, right? I mean, so
Not even a
what
little.
what kind of I mean I speak to I was speaking to a guy the other day who was on the trading floors and just now he's a therapist. So
Yeah,
you know that
Citadel
job
put
wasn't even
most of the
transferable.
market makers out of business.
Yeah.
Yeah, Citadel was the first really, truly industry dominating force I've ever seen in the financial markets. There was the top five firms, top seven firms. JP Morgan was the largest. Goldman Sachs was the fastest. Morgan Stanley and Bear Stearns and Lehman and Solomon Brothers back in the day. And they all fought for that institutional business.
Mhm.
But when Citadel came along, they came at it from the market making side. So they were the equivalent of the exchanges. And I knew 100 guys who worked on the American Stock Exchange floor making markets for options.
Mhm.
And now I know two.
Yeah.
And Citadel replaced everybody else. High frequency trading
Mhm.
replaced all those people. Just made it, it's the speed mattered so much back in the day that, and no, no small processor could ever keep up with Citadel.
It's just a
Now it's
beast.
different.
Yeah.
And now high frequency trading is sort of where those big firms were back in the day. So Jane Street competes with Hidden, competes with Hudson River, competes with Citadel, competes with, a couple other firms that are all in that same business. And they're all extending that space. So now they no longer just make markets, they make bets with a duration, is what it's called, right? So, they'll buy it right now and they'll sell it 10 minutes from now. If
Mhm.
you're a high frequency trader, that's a long time to hold a
Yeah.
position. The
Yeah.
ideal trade for a high frequency trader is I buy it right now in New York, I sell it right now in Chicago. I don't hold either of them for any time. I just take the difference and go home with my money. Don't
Mhm.
put any capital at risk. Jane Street, Jane Street is proving the best at the moment, but Citadel, they take market risk as a part of their trade, and that's made them unbelievably profitable. But the math on that is going to start to slow down a little bit now.
And what do you mean by that?
Well, only so much changes in the next 10 minutes,
Mhm.
right? And that's what program trading is really about. It's about finding information in the world, figuring out what the value of that information is for this particular asset, repricing it, and if the value of it is higher than the current price, you buy it, and lower than you sell it, or the other way around. But the kind of mathematic processes that they use in high frequency trading, because not much changes in the next, say, 5 minutes, the thing that's changing the most is order book depth and new orders arrive, new orders are canceled. There's sort of a slurry of information having to do with what the volume looks like in the markets. The math that you can use to project that information forward only works so far forward.
Mhm.
So you can't look at what the order book is doing this second and project 2 hours from now because the
Right.
math breaks down. It's simply that number 2 hours from now doesn't have enough in common with the number right now for it to be any useful prediction.
Right.
For the next 20 seconds or 2 minutes, yeah, that could be really impactful. You can learn a lot and make a much better projection over that very short time frame. But over a longer time frame, it doesn't help much. And I think we're probably getting to the point where high frequency traders, they're not at the limit. There's going to be more money, but they're getting closer, right?
Mhm.
It's not going to be, they do 89 billion, this year, and they do 160 billion next year, and then they do 500 trillion the year after that. It doesn't scale up infinitely.
Mhm.
Eventually, it starts to slow down the rate of increase.
Yeah, yeah, no, that makes a lot of sense. I mean, you spent decades at the intersection of finance, technology. What do you think most firms still get wrong today?
Well, so I come from the hedge fund space.
Mhm.
The hedge fund industry, uh, people in the press will talk about the hedge fund industry as if that's a homogenous thing. It isn't. Uh, the hedge fund returns are a Pareto distribution, which means that and you've heard of the 80-20 rule, I'm
Yeah.
sure, right? Where the top 20% make about 80% of the money. That applies in the hedge fund returns as well. Most firms don't, in that 20%, which is where I worked, they don't get much wrong at all. In fact, they're very, very careful about not getting anything wrong. That's why they're making 80% of the money. So guys at the smaller end, and the bottom roughly 40% of all hedge funds worldwide lose money every year. So those guys make a couple of really profound mistakes. And I think the biggest one is that they rely principally on luck.
Mm.
They don't, luck is not a business model. That doesn't work. Uh, Central to being in the hedge fund industry is that you're going to be in the market every day, right? So you can't make a big bet today and then take it all off the table tomorrow and walk away and just be somewhere else when your luck turns bad, right? You can't treat it like like a slot machine or like a roulette wheel if you're a business, because that model just doesn't work. And
Mhm.
that bottom 40% prove that every year. They're relying on luck. They're treating it like a trip to the casino. They're thinking, you know, if it's been, uh, you know, the ball has come up black 10 times in a row, red is due. That's literally called a gambler's fallacy. There's a
Yeah,
mathematic error
yeah.
that people make there.
Hmm.
The odds haven't changed at
It
all,
doesn't
right? The
matter.
odds
Yeah.
still, yeah. But because of the way human psychology works, we get it in our head. Well, it's been
Yeah,
a while, so this must be the one.
yeah.
Those guys at the bottom, that's the mistakes they make. The people at the top, they don't make any mistakes. And they hire brilliant people who are at the absolute top of their field to make sure that they don't make any mistakes. The names you might have heard, Paul Tudor Jones owns Tudor Investments. He's my former boss. He's probably one of the better known hedge fund managers right now. I assure you, he doesn't make, if he does make mistakes, I need to reframe that. Individually, of course, he makes mistakes.
Sure.
Uh, every individual in Tudor Investments makes mistakes, but what they do is they manage those mistakes so that when they lose a little, and when they win a lot. That's quantitative risk management. That's what that's called. And that's sort of the domain I've been working in for 35 years.
I mean, it's fascinating, right? I mean, who wouldn't want to be in the space or give money to someone who guarantees they'll only lose a little bit, and when you do win, you win a lot.
Okay. Yeah, well, so it's also one of the most heavily regulated industries in the world. So
Hmm.
you can't actually tell anybody you guarantee anything.
Yeah.
As soon as you do that, you violated the law and all sorts of bad things happen to you. We were
Yeah.
talking about the crypto industry and Michael Saylor. That's one of the problems he's going to have eventually, because he's
Uh-huh.
been out there promising people it's all totally risk-free. I absolutely guarantee you're going to make all those kinds of things will get him in trouble eventually.
Right. Right. Um, yeah, I mean that's it's fascinating. So I mean, what can you dive into a little bit more on what you're doing to mitigate that risk?
Well, I mean they call them hedge funds because in part because they hedge, right? So say for instance, I think two chip providers are fighting over the same contract. I think one is going to get it and the other isn't. But I know that the market could be up or down 20% when that event is announced, when that contract is announced. So what I'll do is I'll buy the one that I think is going to get it and sell the one that I think isn't. So now, if the market goes up and down 20%, I'm making money on one and losing money on the other. And the only way I actually collect a profit is in the difference, the spread between the two,
Hmm.
right? So when that contract is awarded, one goes up a little, the other one doesn't do anything, and the market moves around like this.
Hmm.
I don't have to worry about this anymore, which is called beta. I only have to worry about that little spread difference.
Hmm.
And that's hedging. That's the basic structure of it.
Yeah.
It's that's a very, very, this is a very, very intro level to how hedging works.
Yeah. Yeah.
It's an
Uh,
incredibly technical and complicated thing to do correctly at an institutional level now. Companies like Jane Street and Citadel have elevated this to a mathematic high art that few people, even people in the industry, if you explained it to them in detail, might not get all of it. They're really on the bleeding edge of how that works. And they've hedged away virtually all exogenous risks, right? They're only taking on the risks where they think, the odds are much better they're going to win than lose.
it's incredible. So this brings me to my next question, which it actually feeds right into it, which is great. So all the advancements in AI, automation, we've had these tools, right? They're not necessarily new, but when that black box ChatGPT got released a few years ago, now the whole world's knows about it.
They're
Now,
noticing, yeah.
yeah, exactly. Where do you think? Obviously firms like Citadel are using this and to a full capacity. Where do you think firms are still leaving things on the table? How is the overall market adapting right now?
So there are problems that AI is good at solving, and there are problems that it's really not very good at solving. Um, Coding is a good example. Coding is so if you want to write a piece of software, right? There's a defined number of tools. There's a clear and expected output. It's a constrained decision-making matrix. There's only so many ways you can take this data and produce this output with it. And, if you have a set of tools, which is the code, you're going to get there. So if you do that and you tell it, optimize this for speed or optimize it for efficiency or optimize it for this or that, it can look at all the possible options, figure out what would be best, and then write your code for you. It's very good at solving those problems. Unfortunately, when you're actually conceiving of and designing a program trading system, that's not the same kind of thing. The capital markets, the financial markets are not a random number generator like a casino, which is why casino tactics don't generally work. It is what's called a deterministic system, which means all that price movement that looks like it's random, it's not. That's a bunch of different people, every single one of them doing something intentionally, trying to increase their profit. It's deterministic. If you knew what everybody else knew who was participating in the market, you could predict 100% of everything they do. Unfortunately, that information is unknowable, so you can't actually do that. And the people that use AI to try and solve that problem still operate under the illusion, some of them, I don't want to overgeneralize, still, but many of them, the youngest of them certainly, operate under the illusion that there is a mathematic formula that you can write, which will solve the market. You turn it on and money comes pouring out, and you just, go live on a private island somewhere. And that's not how the market works. Every time you do something, the market reacts to it. We call that market impact. You can't test for it. You can't back test for it. You have to be in the market to tell. And, even if you build a successful trading strategy, over time, it's going to be less successful because the market figures out what you're doing. Your participation in the market changes the test. And that means they have an opportunity to react to you. It's a whole dynamic there where everybody's trying to pick everyone else's pocket. So AI is great for a bunch of things. We use AI in my firm. There are levels of development that we use it for. I personally use Claude on Excel for some analytics.
Yeah.
I'll get a bunch of
So do
data
I.
from one of our developers.
Yeah.
I'll get a bunch of data from one of our developers that's post-trade analytic data. So I want to see, what the distribution of returns is, what the holding period is, what the P&L is, what holding period's relationship to P&L. You can do all of that so quickly just by asking Claude to do it in
Incredible.
Excel.
Yeah. Yeah.
No more click and drag and open up a new sheet and no, wait, this was column C, no, column B.
Yeah.
All this, the mechanics, all that stuff is made incredibly easy. And to be frank, I mean, I might have had to go and hire a junior analyst to do all that crap for me, but for Claude. So it's definitely having a big impact. But to imagine that AIs are one day going to get so smart
Yeah.
that you can just plug in Yahoo Financial data, turn it on, and it'll figure out how to trade the markets, that's science fiction. That'll never happen,
Well, and
in my opinion.
I mean, it's really nice to hear that. I appreciate that insight, and it makes sense to me, right? And for something like there's too many humans involved for you to be able to predict that. there, there's a lot of like you said, every move that's made is someone that has a piece of information that's doing something to make more money.
Well, at least they believe they do.
They believe they
And
know something, right?
the
Yeah,
truth
well,
is they're wrong much of the time. And in some respects, it's easier to predict a huge crowd of people than it is to predict an individual.
sure.
So, uh, you know, a crowd has uh, a more predictable set of behaviors. Most people don't really think about what they do, right? They do the same thing every day. So, if I'm some guy who's, I'm rich, I'm sitting in my penthouse somewhere. I like to trade a little bit, but I don't really do it that much. Okay, so I get up, I make myself some coffee, I read the news, I go over, I look at the markets, market opens up, it's up a little bit today. Okay, now I'm going to trade. Well, guess what? That means 9:45 every day, 10 a.m. every day. This individual guy is showing up to trade. Now, maybe you don't have the same pattern as him of behavior, but you have other patterns of behavior. And your behavior isn't going to be that different from a whole bunch of other people's behavior. So you get a distribution, a normal distribution around any question that you can ask about that group of people. And now you're in a position where maybe it can start to predict
Mm.
what people are going to do. If I know that you like trading tech stocks and you show up every day at 9:45 and there's another 150 million people watching the same thing you are, maybe I can get a handle on it just knowing that information. So this is the process, right? This is how we think about it.
Yeah.
AI will probably be able to deconstruct some behavior from that, but it'll never get to the point where it comes up with a new idea, in my opinion,
Yeah.
or it'll conceive of a new way to approach the markets.
Right. Yeah, I mean, it's certainly right. It does certainly help us. Certainly, some different ancillary tools we can use. Helps on the back office stuff for sure.
Absolutely.
Making us more efficient and better at our jobs. Yeah. I mean, I use it every day. But I also think, people need to be there to monitor and check. And this.
Yeah, we've so one of our developers is using it to write a piece of code, and it's
Mhm,
increased his productivity about 25%. And
mhm,
that's all. And that's because every single line of code that gets written, he's got to go back and read and check and make sure and confirm. And, you know, so is it faster? Yes. Is it an order of magnitude faster? No.
yeah.
It's a it's a modest improvement. And it will get better maybe. And part of it is the learning curve of our
Yep.
developer.
Exactly.
As he gets better at figuring out how to prompt the system or to reuse other things, or, you know, it's like anything else. But yeah, a substantial improvement in all the areas except the one that every college sophomore engineering student is really hoping it can do.
Yeah, you see a lot of it out there. Yeah, all the online trading, just plug it in.
I
Yeah.
get in on LinkedIn, I probably get 50 still. I was getting more. I've been canceling and blocking people. But I got 15 to 20 unsolicited sales pitches for people. Let AI run your marketing, let AI
Mhm.
run your accounting, let AI run you this, you that, you that. Just I was absolutely in an avalanche of them.
Yeah.
So I just started blocking people. Everybody who
Mhm.
sent me an unsolicited sales pitch, I blocked.
Yeah, that makes
It's starting to work.
yeah, yeah, it makes sense. There's a lot of slop out there too. You have to be careful. Yeah, we don't really know who's behind all of that. So, but let's see. If there was a magic wand you had right now and you could just fix one thing in the industry, at your company, what what do you think you would like to see changed?
It's a challenging question. I don't I don't really think of myself in those terms, but since you asked, uh, I there are basically two approaches you can take to how you work in professional financial services. One is, and it's the one that I've had no choice about, is you deal with people honestly, you tell them what you're really doing, you deal with other experts. So as a hedge fund, every one of my clients knows about markets. They know how they work. There are other institutions, their pensions, their insurance companies. They hire people that know a great deal about markets. So I have no choice but to be honest with them. Uh, I do so because I know they're going to check every word I say. And if I come up as dishonest in any way, my business is finished, right? So it is a necessity in the business, to be honest. The retail industry, these guys are taken advantage of in subtle ways, not the ways they think. They think, oh, Citadel is front running me and they're stealing my order. And by the way, I've never worked at Citadel. I don't know anybody at Citadel. I interviewed with, King Griffin 15 years ago for had dinner with him one night.
Hmm.
It's the only contact I've had with the firm. But they are, a force in the industry. So these guys go online and they say, well, the markets are all rigged, it's this and that. No, it's not rigged, it's not that. But you are being taken advantage of. You're being given products like zero-day options. Zero data expiry options are nothing more than a way to transfer money from retail to the market makers. Over time, statistically, that's the only thing that will ever happen with them. Now, there's a lot of elaborate mathematical justifications you can make, but that's all rationalizing. That's all sales pitch.
Hmm.
All that product is designed to do is take money away from essentially gambling addicts on the retail side
Hmm.
and give that money to the institutions issuing the instruments. There are other instruments out there like that too, more every day, that are specifically designed to have an impact on retail that they don't understand. I personally think if you're one of those people, you're doing a bad thing. You shouldn't be doing that to those people. You shouldn't give a heroin addict more heroin.
Yeah.
That's a bad idea, right? That's wrong. So if I could only change one thing, I think that's the thing I'd change, is I would find a way to require these guys to be as honest with retail as I have always had to be with institutions. I
Yeah.
don't know how you do it. I don't have a good solution, but if my solution is the magic wand you just gave me,
Yeah.
that would be one of the things I'd pick. Because I
Yeah.
don't
No.
mind. The motto of the hedge fund industry, the unofficial motto is we only eat what we kill.
Yep.
And we say that because it means our clients' interests and our interests are aligned. If we don't make a profit for them, we don't eat. And that's true as far as it goes. So I don't mind competition. I'm completely comfortable with competition. In some respects, the area of the markets I've come through can be thought of as sort of a gladiatorial pit, right?
Hmm.
Where your individual ability is the only thing that matters. And if you come out every day alive, you win.
Yeah.
Um, so yeah, I don't have any problem with competition. Compete with me all you like.
I
I'm a
see
pretty
that.
clever guy. I think I can manage.
Yeah.
But don't lie. Don't lie to people.
Yeah.
Don't take advantage of people. Don't tell people it's going to be great for them when you know it isn't. When
Hmm.
anybody else knows it isn't too.
Hmm.
That's the one thing I would change. Uh, Retail really is taken horrible advantage of. The and not in ways that you think. These gambling markets, Kalshi and the
Yeah.
other the binary
Poly,
markets.
poly market and
These are very bad. Polymarket, yeah. In my opinion, these are a very bad idea. Very bad. You're going to get all the problems people are complaining of and none of the benefits people are promising,
yeah. Yeah.
in my opinion.
I mean, those are when you can bet on the weather tomorrow, if it's going to hit over 80. It's just, I don't know, man. I don't think it's going to solve any gambling problems either, any gambling addicts problems.
One could certainly assume it's not going to solve a gambling problem. I mean, it's pulling the handle.
Yeah.
It's all, I mean, it's all luck. There's no,
Yep.
and when it isn't luck, it's cheating.
Hmm. Hmm.
So,
Listen, I mean, I really love what you said, though. I mean, integrity, honesty. I mean, that's the foundation of everything that I was brought up on, and just using that in your daily life and in business is so important. And I think it goes to show that. I mean, look at your success, and you're doing so well. And I just really appreciate your time today. And
yeah, sure, my pleasure.
yeah, it was really nice chatting with you. You really broke down things in a very easy way for anyone who's listening today, and I really appreciate that. So, would you like to? Where can our listeners find you, or did you want to share um, your LinkedIn or?
Well, I'm on Twitter. I run a hedge fund, so it's not really appropriate for retail investment. Mostly
Mhm.
it's institutions who invest with us. I did write a book about 5 years ago, which has sold very, very well for given the topic. Excuse me. You can find that on Amazon or whatever, but I didn't come on to sell books. I just came on to chat.
Yeah, you mentioned before you didn't want to make any plugs. It's very humble of you. I appreciate it, Tom. Thank you so much, and enjoy the rest of your day. Okay.
You too. Cheers.
Thanks, man.